Well, we're going to go ahead and get started. Stick to our time commitment here. I'm going to go ahead and share my screen. You got to make sure you always do the right screen. Otherwise, people are, seeing the wrong thing. So what we do here at Captive Nation is we create and manage captive insurance companies. That is what we do. Just give you a little background on me. I am a CPA. I graduated from Texas A&M, got the Aggie ring here. Went and worked for a public accounting firm, KPMG, one of the big four now, and then left there and went and worked at a small CPA firm where we did all kind of things, bookkeeping, audits, tax returns, and things like that. And I started noticing there's a lot of strategies out there that we were not implementing there in the CPA firm. And so I formed Captive Nation. We are a captive insurance management company. Want to make something real clear. We do not do tax returns, bookkeeping, and audits. I'm just a CPA. I work too hard to get those three letters. And so I'm not going to be letting those go anytime soon. So what is captive insurance? It is the premier risk management tool available to business owners. Okay. Without dropping your commercial insurance. Okay, this is going to integrate with it. And this is a business strategy to protect profits, right? So your clients, they're interested in making profits. Now we want to protect them. We want to protect their ability to keep making the profits, so income streams, and then also protect the expense exposures that they have. And captive insurance is a private insurance company, not an insurance product, okay? So let's look at the structure. How does this really work? Well, any business is going to have their owners, okay? They create a business or multiple businesses. Those same owners will create their own captive insurance company. They own it. We do not own it, okay? We just create and manage it for them. But they're going to own their captive insurance company. They're going to pay premiums into their captive, okay? And then their captive is going to pay the business for any losses that they incur through reinsurance. All right. So who is a captive for? It's really any business owner with $1 million+ in gross revenue. Now, I'm not talking net income. Okay. It's just gross revenue. All the revenue, it may have multiple businesses. If all those add up to at least $1 million, they need to be looking into a captive insurance company. They do 5, 10, 15, 20 on up to $1 billion. A captive insurance company works great for them. What types of businesses work for a captive? It's any type. The reason being is that every business has risk. It doesn't matter what kind of business you're in, there are risks associated with every single business. We serve all kinds of industries: physicians, manufacturers, construction, healthcare, oil and gas. Transportation is really big right now because of the increase in commercial insurance, wholesale, retail, even opportunity zones. They're great to put a captive on. What are there's really 3 big benefits to a captive insurance company. And we're going to really focus in on one today, but it's going to protect their business, decrease taxes, and build wealth. That's what a captive insurance company does. Most business owners are interested in doing all 3, right? And so let's first take a look at protecting the business. You want to protect the business that you built. People spend 15, 20 years building, 30 years building their business. They want to be able to keep that. And what captive insurance does is it integrates with your traditional commercial insurance. You're not replacing all your commercial insurance. It just integrates with it. Think of it like this. You've got a pie that is all your risk associated with business. Your commercial insurance is going to cover some of that, but there's all kinds of exclusions, right? I mean, when you get your commercial policy, it's like that thick of the exclusions and 1 page of what's covered. So this covers all of those things. And you're going to get access to policies that are either not available commercially or they're just too expensive. What kind of policies am I talking about? business interruption insurance. You think, well, we've got some of that. You got some of it, but what does it really cover? This is going to cover a lot more. All right. Collections receivable. You may have heard of AR insurance. You can do that inside a captive insurance company. Coronavirus, pandemics. Who knew we were going to have this a couple years ago, right? Well, this will cover the effects of coronavirus. Cyber risk, ransomware. That is, rampant, right? And so this is something that can be covered by your captive. Loss of a key client. Let's say you've got 3 clients that make up 80% of your revenue, and one of them decides to leave to go to your competitor. What do? Well, you cry a little bit, but if you have a captive, it would cover the loss of that client. If they bring in $500,000 a year, you would get a check for $500,000 a year. There is, let's see here, what's some other things? Loss of a key employee, another big thing. A lot of times, companies have one key employee that manages a lot of things. You can get insurance for them. Loss of a key supplier, regulatory change, rental income replacement. So there is a lot that a captive can cover. Rental income replacement is another one. If you have people that have strip shopping centers or commercial buildings, they can get coverage for, if that tenant leaves, they can get a check to cover what they would have paid them for the rest of their rental lease agreement. So that's just a few things that it covers. It covers a tremendous amount more. Again, it's not the focus of today's webinar, but it covers a whole lot. And the business owner is creating a new asset. They're creating a new corporation that is creditor proof. And people get to their business, vendors and other people sue them and yeah, they could. But whatever money that is put into the captive is creditor proof. It's very hard to penetrate a captive insurance company because it is an insurance company. And there's there's certain protections for insurance companies because they're there to pay claims. And so there's special protections for that. Now, big part of a captive that people love, all right, CPAs, business owners love this aspect of it. I'm going to tell you right from the get-go, the primary purpose of a captive insurance company is to insure the business. It just happens to come with a great tax advantage. You get to keep more of what you earn. And here's how it works. The premiums are tax deductible for the business. But when the premiums go into the captive, they're tax-free. All right. So you're getting that business deduction because you're paying the premiums. The money goes into your captive, and now there's money sitting inside of your captive because of the premiums that you paid. So I'll give you an example. We met with a couple of years ago, a company, they build storage facilities, not storage facilities, but retention facilities on the border. And they've been quite busy. And so they had a profit that year of $1.5 million. And so the owner gave a financial advisor $1 million to invest. And so I was in the meeting, we were doing some planning for him. I said, okay, just make sure you save $400,000 for the taxes you're going to have to pay. He's like, what are you talking about? I'm like, yeah, well, yeah, you made $1 million. You need to make sure you're going to pay taxes on it. Now, or you could put that into the captive by paying insurance premiums and you keep the $1 million. So he looked at the financial advisor and he's like, give me my money back. I'm going to put it in the captive and then you can manage the money there because I get a 40% return on my money. So he was thinking ahead as far as, hey, this is, something that I can do that's going to immediately pay off, right? Get like a 40% return on my money. Let's look at how that works. All right. So when we have a business, let's say they make $500,000. Okay. If you have a captive, you can deduct those premiums. And let's say it's $500,000. We don't know what it'll be. But now your taxable income goes to zero for the business, whether they have a C Corp, S Corp, whatever. it goes to zero. What happens to the money? It goes over to the captive. Now that's captive premium income. But remember the second exemption? You get to exempt that premium income. So now your taxable income for the captive is zero as well. So when business owners come to you and say, you know, what in the world can I do? You know, this year I'm trying to, you know, I want to protect my business. Is there how can I save on taxes too? Look at what this does. It's a nice benefit, because if you don't have, you've saved that client $200,000 if they're in the 40% tax bracket. Otherwise, if they don't have a captive, they're just paying the $200,000 in tax, and their business is not protected. So it is a huge deal to be able to get that done. How is this possible? It's the 831B exemption. Occasionally, you will have the Journal of Accountancy. They'll have some articles on captive insurance company. It's not very often, but you know, they'll have some articles, and this is all about that. When you write a check for the premiums, it's a tax deductible expense. The premium though goes into the captive, and it's not taxable under the 831B exemption. This is an election, okay, and it's just for insurance companies that are non-life insurance companies. This has been going on since '86. It's just that a lot of people haven't known about it. And so that's kind of one thing we're doing, is taking it to the small and medium-sized business. The old deduction was 1.2 million. Okay, now that's per year. Okay, but there was the annual maximum premium deduction was $1.2 million per year. And you were only taxed on your investment income. The underwriting profits and reserves remain tax-free. There was a big change in 2015. It was very positive, but it came with a little hitch. You were able to exempt now up to $2.3 million per year can go into your captive. And again, deductible expense, you do not pay taxes on that premium income. They changed one thing though. They said the ownership of the captive has to mirror the ownership of the business, right? Because years ago, what people were doing is, you know, mom and dad would own the business, the kids would own the captive. And so that's how they would do a lot of wealth transfer. They caught on to that. And so they changed the rules where it has to mirror the operating entity. So here's something that's interesting that, you know, when we look at tax planning, you know, what happens a lot of times at the end of the year? A business owner is like, okay, I made a lot of money. It's a great year. Love it. How in the world? I do not want to write a big check to the IRS. And so what a lot of CPAs will say is you need to go buy equipment. Well, this was a case where I call it the $1 million miss, because this was a true case of a construction company. The CPA suggested buy $700,000 worth of equipment. They didn't really need it, right? But they would rather get something for the money they were about to have to spend one way or the other. They did the 179 deduction. The problem with that is that in 5 years, how much is that really worth, that equipment? Maybe zero, maybe 200,000, or that business owner, they worked with a CPA that we knew. They put the same 700,000 into a captive. They got the same deduction off their taxes, but they kept the $700,000 in an asset that goes up in value. Because when the money goes into the captive, you can invest that money into Wall Street funds. Okay, so that investment will probably go up over the next 5 years versus an equipment depreciates. In 5 years, how much is that $700,000 going to be worth? Probably like around 1.2 million if they get what's on average, you know, what the stock market has typically averaged. So that's now $1.2 million. And so that's the $1 million miss. If I do equipment, right, I would only have 200,000 versus a captive, I would have 1.2. It's $1 million miss. Now you do eventually pay taxes on that money when it comes out of the captive. All right. So, but it's at lower tax rates. So you're going to be, it's capital gains rates. And so your distributions are at capital gains rates. So when you look at the overall captive structure with your business, now your profits come out, depending on where you live, you're going to be paying 40 to 50% in taxes to your owners. Or the captive, the money can go in there. The money keeps growing, right? I have profits. And then when I pull it out, I pay capital gains. And right now the rates are 15, 20%. The third thing that captives do is that they build wealth, right? Because the money that goes into the captive, I'm able to keep. I retain those premiums. When you use traditional commercial insurance, how many times has State Farm called you and said, hey, Jerry, you never had a claim this year, so we're going to give you all your money back. Well, that never happens, right? It never happens. But with this, that's exactly what happens. You get to retain those premiums because you own the insurance company. You can invest those premiums, and don't forget, all of them are reinsured. So all the policies that you have are reinsured. So if something does happen, we're going to be able to pull from that reinsurance, not just from the money in the captive. And all the time, the money is growing. Typical Wall Street investments is what you can invest in, right? Mutual funds, ETFs, things like that. Something else that it does is that it reduces your traditional commercial insurance cost. Again, you don't drop it, but a lot of times it can reduce it. And a lot of this is done by increasing the deductible, right? There's a policy called differences in condition, and that's going to cover your exclusions and your deductibles. So this gives you the freedom to increase your deductible, knowing that if you need the money to pay that bigger deductible, you can grab it from the captive, and that will produce a lot of savings. How much savings? We had a client that they built buildings, all right? And they were a big business. Their general liability, workers' comp, commercial auto, all together ended up being $2.5 million per year. So we talked to them about a captive and how this can integrate. They increased their deductible, and look at the savings that they had. Now their premiums for all those things was only 1.5 million. They saved $1 million in costs. You see the value of a captive insurance company? You're getting more coverage for less money, and that is protected money. So lots of value there. Another reason to do a captive insurance company, and we have some people, this is the only reason why they do it, is for creating warranties, right? So if you have you manufacture a product, let's say you go to Best Buy, you buy a TV. What's the last thing they ask you at the cash register? Do you want the warranty, the extended warranty, right? Every single time. That's a captive insurance company. All that money is going into a captive, right? Your clients can do the exact same thing. Now, they can create a warranty. They can either charge for it or not charge for it. It's up to them. If they charge for it, again, the extra money is going right into the captive. Here's an example of a commercial range company we had. They didn't want to charge for the warranty. All the competitors, these are commercial ranges that they use in restaurants. They're pretty expensive. Everybody offers a 1-year warranty. So they said, hey, can we offer a 2-year warranty and not charge for it? Well, sure, do it. So they did. Sales went through the roof. Why? If I'm going to throw down 10 grand for a commercial range, I want to make sure it lasts more than 1 year. I want to make sure it lasts at least 2 years. And so is a huge competitive advantage on that. So why choose a captive? If you don't have a captive, all these things, this risk, you don't have coverage for. It's like you're already self-insuring, but you're getting no benefit for it. All right. You make profit, you pay taxes on the profit. You're not covered for all these things. Or you can choose a captive insurance company. Okay. That profit could go over to your captive. And remember, you get that exemption, right? And then you have insurance. That $1 million is going to buy you $10 to $30 million worth of coverage. What kind of coverage? All of these types of coverages, right? There's a tremendous amount of coverages that they could get. So it's protecting your business. It decreases taxes. and it builds wealth, because that money in the captive is now invested and earning even more money for the business owner, or they have a whole new profit line in the warranty insurance income space. So it is interesting. You typically end up financially ahead by owning a captive insurance company. It actually increases cash flow instead of decreases cash flow. And again, your risk are covered. You got to remember, it's a true insurance company. The operations are for risk management. All the policies are actuarially supported. We hire an independent actuary that will, they are the ones that go and measure the risk and come up with policies and the exact premiums. Capitalization, it's a corporation, so it's got to be capitalized. And then there is the risk transfer and risk distribution that is required of all insurance companies that you do. Formation process is easy. The first thing that we do is we want to see, does this make financial sense to do? We do this on a complimentary basis. If you got a client, it may be you or a client and say, hey, does this make financial sense? We're going to look at it and do a cost benefit analysis. Determine, okay, what are all the benefits? What are all the costs? Does this make sense to move forward? Then we do the underwriting. That's where we hire an independent actuary that's going to measure the risk, come up with the policies and the pricing. If the business owner likes that, we move right into the formation stage. We form the corporation, obtain the insurance license, get all the tax ID numbers, issue all the premiums. The premiums are paid. And so we handle all of that with the state insurance department. And then the last stage is the management. There's ongoing management that has to occur. Okay, we do all the financials, all the tax returns, everything that has to do with operating a captive. We do. So it's kind of a turnkey deal. I'll tell you one thing that I didn't put in there. All of our captives are formed right here in the US. We don't do any offshore captives. All of them are right here done in the US. So if you have a client in mind, we can run a feasibility study for them. We're happy to do that. And so I kind of wanted to open this up to see if you had any questions. You can, if you have been muted, feel free to open that up and unmute and ask any questions that you have.
Hey, Ken, I got a question for you.
Yeah.
Hey, I typed you a couple private ones, but it's probably info that others will like.
Sure.
When we pull money out, is it through a LIFO formula, last in, first out, or capital gains?
Yeah, you typically can pull out around 20% of the premium every single year, and it's all capital gains. So it's not LIFO. It's just whenever you pull money out of the captive, whether it doesn't matter if it's 5 premiums from 5 years ago or this last year, you're going to pay capital gains rates on that. So yeah, that's a great question. So all money that goes in when it comes out is going to be capital gains. You don't have to pull money out, okay? But if you do, you pay capital gains. If you don't, that just keeps growing. And a lot of people use this as kind of retirement money, right? So they eventually sell their business and now they have this big asset. If you never pull money out, let's say you sell your business and then you could liquidate that and pay capital gains, or keep it as a C Corp and go buy rental homes, apartments, whatever. And again, at that point, you have not paid any capital gains on that money. So yeah, great question. Great question. It's excellent. Anybody got anything else on that? One other thing, if you were to die, we don't want anybody to die. Okay. But if that were to happen and you had the captive, your heirs would get the stepped up in basis. And so your heirs would not be paying any capital gains rates as well. Okay. I think, all right. So I think that answers. If anybody's got any other questions, go ahead and say it now. If not, feel free to give me a call. My office number's there, my cell number's there, or you can email me there at ken@captivenation.com. Again, if you have any clients in mind, happy to talk about what a captive insurance company would look like. We would come up with the different types of premiums and the pricing and kind of what the cost structure would.
How long does it normally take to set one up from start to finish?
Great question. 30 to 60 days.
30 to 60.
30 to 60 days.
Any idea on a price range? Is there?
Yeah, it varies depending upon the size of the captive. But the setup costs run from a low of around 25,000 to 55,000 for a really big one. But you're looking at probably around 25 if it's a small captive. And I can tell you typical ranges. We've got clients that put in 75,000 a year. We got clients that put in 10 million a year. Those are regular captives, but it can vary. But if you're only going to put in 20,000, that's not going to really move the needle. It's got your costs are going to be greater than that. But
Is that
sometimes,
per year?
Yeah, per year.
Cost?
Right. Yeah. No, the setup cost is a one-time setup. So that one-time cost of 25 to 55. Going forward, every year after that, the expenses are about 5 to 10% of your premiums on average. Okay. So 5 to 10% of whatever amount of money you're putting into there via premiums is what your ongoing expense is going to be. Every year there's premium taxes on these. An audit has to be done for them every single year. There's an actuarial review that has to be done. So there's a lot of things that have to be done that add to the expense. So, all right, we have one other question.
Are there any captive funding restrictions?
Captive funding restrictions. As far as how the money gets in there.
Yeah, so say for instance, they have a client that has a line of credit, or can they, instead of using capital from the business, can they pull from their line of credit to put the money in?
Sure.
Use tax savings to offset the interest?
Absolutely. Yeah. Yeah, you could do that. We actually have a company that's what they focus in on is financing premiums for captive insurance companies. So let's say, you get to the end of the year and you got a client, they're going to get a lot of money in March, but they want to do a captive this year. Well, then they could finance the premiums, still get the tax deduction for this year in 2021, and then pay that back based upon whatever terms they work out. So yeah, you could do that. And the money just needs to go from the company to your captive insurance company. So that's a great question. Great question. So yeah, well, hey, feel free to give me a call or email me. Happy to talk about anything about this, but great business strategy. Again, it protects the business, decreases taxes, and build wealth. I'm Ken Huffman. I enjoyed visiting with y'all, enjoyed this webinar, and look forward to hearing from you. We'll talk to you soon. Bye-bye.